These are just a few of the tech companies whose share prices have fallen in 2022. And here's a chart of the percentage change in the tech-heavy NASDAQ compared to broader indexes. While stocks are down in general, the tech industry is having an especially hard time. And in April and May, a wave of layoffs and hiring freezes hit the sector.
The story of what's happening with tech is not just a story about this year or even the last year itself. It's really a story about what's been happening over the past decade.
While other sectors have faced declines, here's why the tech industry is having a record downturn after years of growth. 10 years ago, the tech industry was ready to grow. The US was still recovering from the Great Recession, and interest rates were hovering near zero.
The Federal Reserve is using its monetary policy tools to promote a more robust recovery.
So low interest rates, they're good for tech stocks. Lower yields make it really, really easy to, they increase the appeal of the future earnings that a lot of these tech stocks will have.
In 2012 and 2013, tech players like Facebook and Twitter went public. And advancements like mobile and cloud technology helped drive profits for many companies and fueled growth in the sector. Let's go back to that NASDAQ chart. We can see how the tech industry steadily grew over the decade as money poured in, outpacing growth in other industries. As revenue grew, companies also expanded their workforces. For example, Facebook added about 40,000 employees to the company between 2012 and 2019. By the end of that year, tech was at the forefront of the stock market, with a bull run being driven by companies like Apple and Microsoft.
2010s were really the decade of disruption for a lot of these tech stocks. We really started to, be on our phones longer. We started going on social media. And all these factors combined really, really increased the allure of tech stocks, and investors wanted a piece of it.
Low interest rates and increased smartphone use were vital contributors to growth.
Those two factors combined together really made it easy to, just sort of go into the tech trade, and really led to the valuations of a lot of these tech companies to become really inflated, really lofty.
Then 2020 hit.
The breaking news, stay at home. That is the order tonight from 4 state governors.
Stocks across the board initially took a plunge as stay-at-home orders and lockdowns rippled across the world. With more people stuck at home, the tech industry was set up to capitalize on demand.
When the pandemic first started, we had all these lockdowns, we had travel restrictions, and people were stuck at home. So what do you do when you're stuck at home? You go online and you binge watch shows on Netflix. You want to talk to your friends, you go to Zoom.
At the same time, Washington enacted a massive stimulus plan. The government sent out more than 150 million stimulus checks, and the Fed made plans to lend billions of dollars across markets.
We have held our policy rate near zero since mid-March and have stated that we will keep it there until we are confident that the economy has weathered recent events and is on track to achieve our maximum employment and price stability goals.
The Federal Reserve slashed interest rates, and they were historically ultra low. And that made it also very, very easy for a lot of these tech companies to take on cash, to borrow more money. It lowered their borrowing costs. So yeah, that altogether really helped tech stocks get to the levels they were at in 2020 and 2021.
As stimulus flooded the economy, market cap prices for tech leaders like Amazon, Apple, and Meta reached new records. Some companies significantly grew their workforces to meet rising demand, announcing increased hiring during earnings calls to shareholders.
We ended the quarter with over 71,900 full-time employees, up 23% compared to last year.
We finished the quarter with nearly 3,800 employees, up 134% year over year.
But growing valuations flashed a warning sign to some analysts, who speculated that companies might not be able to keep up with the exploding growth. Inflation was beginning to take center stage.
We had Federal Reserve Chair Jerome Powell come in and say that, we're now going to start thinking about raising rates to fight inflation because it seems like it isn't temporary anymore.
High inflation is a severe threat to the achievement of maximum employment and to achieving a long expansion that can give us that.
And that sent investors absolutely freaking out, panicking about these tech companies.
Share prices for small tech companies and giants alike started to slip. While inflation, supply chain issues, and the war in Ukraine were impacting businesses around the world, tech was being faced with other unique challenges. Ad revenue, which social media companies like Snap, Twitter, and Facebook rely on, has taken a hit as inflation led companies to spend less on advertising. And Apple introduced a privacy feature last year that restricts user tracking, which means that sites have a harder time targeting ads to users. Companies now had to redesign their ad targeting and tracking tools to comply with the new rules, and by doing so, lost business. Meta estimated that Apple's ad tracking changes would cost the company $10 billion this year. Another issue that caused earnings to take a tumble is changing consumer behaviors.
So previously, we were all at home ordering stuff online again. And now we're shifting back and going back in person. We're going to restaurants, we're going to stores.
Companies are looking to cut costs, having expanded when growth was booming. In a shareholder meeting, Meta said that,
given the resulting revenue headwinds, we have adjusted our plans for hiring and expense growth this year.
Carvana CEO said in an email that they would cut around 2,500 workers. And Robinhood said in a shareholder meeting on their increased hiring that,
at the time, we thought that this was right to keep up with the pace of the business, but it also led to some inefficiency, some redundant roles.
Stocks have dropped quickly amid poor earnings results and the slowdown in growth. Now, some investors are bailing on volatile tech stocks as interest rates rise.
So tech companies also include some of the most speculative companies in the market and riskier ones as well. So it makes it really, really hard for you to justify owning something that's not going to be profitable for a long time in the future to come.
It's unclear where the market might go from here.
Analysts and investors right now remain divided about whether this slowdown is going to be temporary or permanent.
And not all tech companies have been hit as hard. IBM and Citrix have both continued to outperform the declining market. But with the Federal Reserve expected to steeply raise interest rates, analysts say tech stocks will continue to suffer.